Okay, so you want to own an apple orchard. You find the land, rolling hills in Chelan County, maybe the Wenatchee Valley, maybe out past Yakima, where the rows go on until they hit the ridge line. You plant the trees. You watch them grow. Every fall, harvest crews move through and the fruit comes off and you sell it, and the land underneath you gets more valuable every year while you do. Your name on a gate, a fruit stand by the road if you want one, clean work, beautiful land, an asset that feeds itself. And honestly, that picture isn't wrong. That is what a Washington apple orchard looks like from the road in October. That is the version that gets photographed and listed and talked about at the dinner table. The land isn't the business. Here's the first thing nobody tells you. Before your new block of trees produces a single sellable apple, you will spend somewhere between $3,000 and $5,000 per acre just getting to the point where the trees are old enough to be worth harvesting. That bill runs for 4 years minimum, sometimes 6, sometimes 7, depending on variety. And it runs whether it rains or doesn't, whether labor shows up or doesn't, whether the market wants your apple or doesn't. Some orchards in Washington have been printing quiet, stubborn income for 3 generations. Others have bled their owners steadily and invisibly, while the land underneath got more valuable every year, which is its own kind of trap nobody warns you about. By the end of this, you'll understand exactly which mechanism decides which one you're living. So let's start with what an orchard actually is, because the word covers a lot of different businesses that barely resemble each other. In California's Central Valley, an almond orchard is essentially a water futures position that happens to have trees on it. You are betting on groundwater access and commodity export prices to China and India simultaneously. In Florida, citrus is a disease management business. Citrus greening, a bacterial infection spread by a tiny insect called the Asian citrus psyllid, has destroyed roughly 70% of Florida's orange acreage since 2005. In Michigan, sweet cherries are a weather disaster business with spectacular upside windows. A single late frost in May can eliminate the entire crop, and growers know going in that they will lose several seasons per decade to weather alone. Washington apples are a different animal. Washington produces roughly 60 to 70% of all the fresh apples sold in the United States. The state's combination of volcanic soil, high desert climate, and Cascade Mountain snowmelt irrigation creates growing conditions almost nowhere else can replicate. That geographic advantage is real. It is also exactly why the economics are more complicated than they look, because when one region dominates a commodity, every cost problem and every price problem is concentrated in the same place at the same time. The script for this is a mid-size commercial operation. Call it 150 to 250 acres, large enough to supply a regional distributor, small enough that you are still making every capital decision yourself. This is the scale where the ownership fantasy and the operating reality collide most directly. Here's the thing that resets everything you thought you understood about this business. The packing house is not your friend. In most of Washington state, you do not get to choose it. Your apples go where your contract says they go, and that contract was almost certainly signed before you bought the orchard. The packing house grades your fruit, stores your fruit, markets your fruit, and sends you a check months after harvest, minus its handling fee, minus its storage fee, minus its marketing assessment. You grew the apple. Someone else decided what it was worth. Getting into a Washington apple orchard at mid-size commercial scale means starting with land that already costs between $25,000 and $45,000 per acre in the Wenatchee and Chelan areas, and significantly more in premium blocks with established water rights. A 200-acre orchard in a strong growing district puts your land acquisition somewhere between $5 million and $9 million before you have touched a single piece of equipment. That number, by itself, is not the problem. The problem is what comes next. Established orchards in Washington are increasingly planted in what the industry calls high-density systems, trellis-supported, closely spaced trees on dwarfing rootstock that produce more fruit per acre faster than traditional plantings, but require a permanent trellis infrastructure that costs between $15,000 and $25,000 per acre to install. On 200 acres, that is $3 to $5 million in wire, posts, and irrigation line before the first tree goes in the ground. Then, the trees themselves. Planting stock for a modern Gala or Honeycrisp block runs between $5,000 and $8,000 per acre, depending on variety and rootstock. Add the 4 to 6 year establishment period where the block costs you roughly $3,000 to $5,000 per acre per year in water, labor, fertilizer, and pest management, and produces little to no revenue in return. The largest apple and pear operation in Washington state, Brocha Orchards near Prescott, was running yields of around 800 to over 1,000 boxes per acre on mature blocks. But even Brocha had to get the trees to maturity first. Every acre costs you before it pays you. The inherited trap on most mid-size orchard purchases is this. You are buying blocks at different stages of their productive life. Some trees are 12 years old and in peak production. Some are 25 and starting to decline. And buried in the purchase agreement is almost always a replanting obligation, a schedule sometimes contractually tied to your packing house agreement that requires you to pull aging blocks and replant on a timeline that has nothing to do with when you are financially ready to do it. You didn't plant those trees. You are paying to replace them anyway. The revenue picture on a mature Washington apple orchard is real, which is part of what makes the economics so genuinely difficult to read. A healthy mid-size operation running 200 acres of mature Honeycrisp and Gala at 800 to 900 boxes per acre is moving somewhere between 160,000 and 180,000 boxes in a good harvest year. The base mechanism is straightforward. Fruit comes off the tree, goes to the packing house, gets graded, packed, and sold into retail or export channels. Your check arrives after that process completes, typically 60 to 90 days after harvest ends. The second layer is variety premium. Honeycrisp commands a meaningfully higher per box return than commodity galas, often 50 to 80% more in a normal market year. Growers who transitioned early to Honeycrisp blocks in the late 1990s and early 2000s captured that premium before the variety became widely planted enough to compress the price. New plantings of Honeycrisp today are entering a market already crowded with Honeycrisp. The premium is real, but narrowing. The third layer is controlled atmosphere storage. Apples held in CA storage, sealed rooms where oxygen is reduced to slow ripening, can be held for 8 to 12 months and sold when market prices are more favorable than at harvest. A cold storage facility sized for 200 acres costs somewhere between $1 and $2 million to build. Growers who own their storage can capture that timing advantage. Growers who rely on packing house storage pay for the privilege and lose control of the timing. The fourth layer almost nobody accounts for up front is the water right itself. In Washington's arid growing districts, a senior water right attached to productive orchard land has real, standalone market value. Sometimes valued separately from the land in transactions, sometimes the deciding factor in whether a distressed orchard sells at all. That right is an asset. It is also the thing that disappears first in a drought year if your right is junior to someone upstream. Here is the false comfort number that trips up almost every buyer. Occupancy rate has an orchard equivalent. It is yield per acre. 800 boxes per acre sounds like a strong business, and it is a strong agronomic result. But yield per acre tells you nothing about what those boxes are worth when they reach the packing house, nothing about what the packing house takes before it pays you, and nothing about what the market will offer the week your fruit hits the sales floor. The number that actually determines whether you made money this year is net return per bin after all packing house deductions, and that number is set by forces you cannot control and do not know in advance. Or the operating cost structure on a mid-size Washington orchard is where the romantic picture finally goes quiet. Labor is the largest single operating cost, typically representing 40 to 50% of total annual expenses. Apple harvest cannot be mechanized at commercial scale for fresh market fruit. Every apple that ends up in a grocery store was picked by a human hand. A 200-acre operation needs somewhere between 80 and 150 harvest workers for a window that runs 6 to 10 weeks, depending on variety and ripening sequence. Under the H-2A agricultural visa program, which most mid-size Washington growers now depend on for their harvest workforce, the employer covers housing, transportation from the worker's home country, and a federally mandated adverse effect wage rate that has been rising consistently, above $18 per hour in recent years for Washington state. You are not just paying wages. You are paying for the infrastructure that makes the workforce legally possible. Water is the second pressure point. Irrigation districts in central Washington charge annual assessments that run between $200 and over $500 per acre, depending on the district and the delivery system. In drought years, junior water rights holders face curtailment, meaning the water physically does not arrive in the volume you planned for. A dry July in a Honeycrisp block does not just reduce yield, it affects fruit size, and undersized Honeycrisp gets regraded at the packing house into a lower price tier you did not budget for. Pest and disease management runs between $800 and $1,500 per acre annually on a well-run block, covering codling moth, fire blight, powdery mildew, and the spray programs timed to specific growth stages. Miss a spray window by 48 hours during fire blight season, and you can lose not just this year's crop on a branch, but the branch itself and, potentially, the tree. The fragile mechanism underneath all of this is not any single cost. It is the timing structure of the entire business. Your costs run January through December. Labor, water, spray, equipment, loan service on your land and infrastructure. Your revenue arrives in one concentrated window, starting in October, then trickling out over the following months as the packing house works through your fruit and sends settlements. A grower with a bad harvest in September does not get a reduced cost structure in the months that follow. The irrigation district still sends its assessment. The H-2A workers still need their housing. The equipment loan does not pause. You are running a capital-intensive perennial business on a cash flow calendar built for a grain farm. Brocia Orchards. Remember that name from the yield numbers earlier. Ralph and Cheryl Brocia built what became one of the largest privately held apple and pear operations in the United States, roughly 6,000 acres near Prescott in Walla Walla County, Washington state. This was not a hobby farm that got lucky. It was a decades-long, deliberately constructed, vertically integrated operation. The Broches owned their own packing facility, ran their own cold storage, built housing for their workers on the property, operated a farm store, ran educational programs for employee families, and reinvested operating income back into the community they had essentially created around the orchard. By any reasonable measure, Brocia Orchards was the orchard ownership dream taken to its logical endpoint. They controlled more of the value chain than almost any comparable operation. They were not at the mercy of a packing house they didn't own. They had scale that let them weather bad years that would have ended smaller operations immediately. And yet, in 2019, after Ralph Brocha's death and with Cheryl Brocha aging, the family sold. The buyer was an investment group, the Brocha name, eventually passing to new ownership that continued operating the land as a commercial agricultural asset. The transition was not a collapse, it was not a bankruptcy, but it revealed the central truth of even the best-run orchard at the largest scale. The business is not separable from the people who built its specific set of relationships, contracts, workforce systems, and institutional knowledge. When that generation steps away, what transfers is the land and the trees and the infrastructure, not the operating intelligence embedded in 30 years of managing that specific ground. The financial picture at that scale illustrates the mechanism more sharply than any smaller case could. Brocha's packing operation was processing fruit from its own acres, plus custom packing for other growers, a revenue diversification that most 200-acre operators will never access. Even with vertical integration, even with scale, even with decades of established relationships with retail buyers, the business required continuous capital reinvestment in replanting, equipment, water infrastructure, and workforce housing that never stopped. The orchard that looks like a finished asset from the road is always, from the inside, a construction project that never ends. What the Broacha story makes undeniable is this: if a 6,000-acre, vertically integrated multi-generational operation with its own packing house cannot outlast the founding generation without a sale, the 200-acre owner-operator buying their first block in Chelan County should understand clearly what kind of business they are entering and what it will take to exit it. So who actually makes money in Washington apple country without taking on everything that just described? The answer is not romantic, but it is very clear. Farmland REITs, real estate investment trusts that own agricultural land and lease it to operators, have been quietly capturing the land appreciation side of orchard economics without touching the crop price risk, the labor dependency, or the capital commitment gap. Farmland Partners, one of the largest publicly traded farmland REITs in the United States, owns permanent cropland, including orchard ground, across multiple states. Their model is straightforward. They own the dirt and the infrastructure. A tenant operator farms it under a lease that transfers crop risk to the person closest to the trees. The REIT collects rent. The REIT captures long-run land appreciation. The REIT does not wonder in September whether the Honeycrisp price will cover the H2A housing costs from August. The second class of winner is the large, genuinely vertically integrated commercial operator who owns their packing line, their cold storage, and in some cases their own retail relationships. Companies operating at a scale where the packing margin that crushes a 200-acre grower is profit flowing back to themselves. These operators exist in Washington's tree fruit industry. They are not small. They did not get there quickly. And they did not get there by buying one beautiful orchard and hoping the math worked out. The uncomfortable version of this picture is that the orchard most buyers are imagining, the 150 to 250 acre operation, owner-managed, beautiful land, serious agricultural business, sits almost exactly in the margin zone between too small to control its costs and too large to be a lifestyle farm. It is large enough to require institutional scale management of labor, water, and capital. It is too small to capture the vertical integration advantages that make the numbers actually work. Here is the honest version of what the math looks like. In a good year, strong yield, no frost damage, Honeycrisp prices holding, packing house settlements arriving on schedule, a well-run 200-acre operation might clear between $200,000 and $400,000 of net operating income after all costs, debt service excluded. On a land and infrastructure base worth $7 to $12 million, that is a cash return in the 2 to 4% range, which is real money, which is not nothing, but which is also a number that demands nothing go wrong. In a bad year, late frost in May, coddling moth pressure that got ahead of the spray program, a Honeycrisp glut in October that compresses per box returns by 30%, that same operation can finish the year flat or negative while carrying full debt service on land that the county assessor has valued higher than it was worth 12 months ago. The land got richer. The operating account did not. What determines which year you're living is a combination of decisions made years before that season started, the variety mix you planted, the water rights you secured, the packing house contract you signed, the debt load you carried into the establishment period. The weather is not a variable you can manage, but the structure underneath either gives you the margin to absorb a bad weather year or it doesn't. The honest uncertainty in this picture is variety transition. The apple market has been moving toward proprietary club varieties, Cosmic Crisp, Sugar Bee, Kiku, where the grower licenses the right to plant and the variety owner controls supply by limiting who can grow it. A grower in a club variety program with contracted acreage has a pricing floor that an open market gala grower does not. Whether those programs hold their premiums over the next decade as licensed acreage expands is the central open question in Washington tree fruit right now. An apple orchard is not a farm that happens to appreciate. It is a long-duration biological asset that requires continuous capital commitment years before it produces, seasonal cash flow management across a 12-month cost structure and a 2-month revenue window, and a set of contracted relationships with packing houses, water districts, and labor systems that you inherit whether you want them or not. The land underneath it may well be one of the better stores of value in American agriculture. The business operating on that land is something else entirely. People who understand the difference before they sign have a chance. People who discover it after are already inside the commitment gap, paying to grow trees whose first harvest is still years away. Washington apple country is genuinely beautiful in October. It is also exactly as complicated as this. The land does not care whether you understood the business.